So for today's session, we've got Su-Ching, which is our CFO and our senior associate. So we have this angel investor insight series on a monthly basis where we get different sort of investors to come and speak about their investing experience and their forte, what they specialize in, and to share that education with those of you who might be new to ECF or who just want to learn a bit more about the private equity space. So who we are, we're Leet Capital, right? We're one of the 10 licensed ECF operators. We got our license around March last year. So we're still the newest one on the block. But what we have is we have what we call a 1337 or Leet ecosystem. So we don't just help these companies raise money, but we also invest in them. So we run accelerator programs, and then we invest in the winners of those programs, as well as other startups that we meet. So we've invested in over 50 startups from the accelerator program, and so the ECF platform was a means to sort of bridge that funding gap in terms of helping the more later stage startups and SMEs scale and grow. So what is ECF, right? So for those of you who don't know or new to ECF, ECF is basically now a means for you, the public, you and me, to invest in these private companies. If you know the space, you know that investing in private companies, you need to have a lot of excess wealth with you. So these individuals are usually the angel investors or the sophisticated investors, or even the institutional investors like your VCs and your private equity firms. But with ECF now, you can basically invest in maybe your favorite bakery shop that you've been going to since you were a kid, and now they want to expand and have 5 outlets all over Kuala Lumpur. And so you can not just be their investor now, but you can also be their investor and share in the growth of the company. And one unique thing about ECF is that we use a nominee structure. I won't go into too much detail on how the nominee structure works, as we'll talk about that later on. So before we get started, how do you register as an investor on Leet Capital, right? You go to leet.capital, you select sign in, you click on register account, you click I want to invest to register as an investor account, and then you fill in some preliminary details, and then you do your onboarding where you need to key in your IC number. And so we need all this to do our KYC procedure. It's really important for you to upload your IC over here. If you don't upload your IC, front and back copies, we will not be able to verify your account. And this is probably one of the most important parts of onboarding as well. So you need to really think about what investor type you are. There are sort of guidelines there, and you can go and read up about more detail on the more detailed guidelines as well. But generally, if you're an angel investor, you're looking at having an annual income of over 180,000. And for a sophisticated investor, you're looking for annual income over 300,000. And if you're an angel investor, if you're registered with the Malaysian Business Angel Network, you have an ID, so you can reach out to us and pass it to us as well, and we can verify if you are registered with them. Otherwise, you would fall under retail investors, and the retail investors usually have a cap in terms of how much you can invest in a campaign. It's usually capped at 5,000 ringgit, but this is soft limits. So you can go above that 5,000 ringgit, but you do it at your own risk, and this is simply just to protect your interest as a retail investor. And that's pretty much it. So your account has been created. We'll verify by doing our KYC procedure, and if everything is okay, you could now start investing in the deals. And the good thing about registering as an investor is that you stay up to date with all our latest deals. So if you haven't done already, please go and do so. Right, so before we get started in today's session, we've got 2 questions for the audience members. The first one is, do you have any prior experience of investing in the private equity space, be it through ECF or if you're an angel investor in other private deals? And the second one is, are you aware of the different equity instruments used in a private equity deal, which is basically the core of this topic. We'll just give everyone a minute to sort of answer. Right. Okay, so we've got more than half people not investing in private equity before, which is what we usually see from our webinars. Most people have not invested in a private equity deal, but it's good that you're reaching out and starting to learn about this space to sort of diversify your investments as well. So thanks everyone for taking the poll. Right. So back to today's session. So as I mentioned earlier, we've got Su-Ching, our Chief Financial Officer of Leet Capital, and we've got Anne here as well, which is our Senior Associate. So before we get started, into today's topic, maybe Su-Ching and Anne, just give our viewers a bit of background about yourselves.
Perhaps I'll just start first. My name is Su-Ching. I started my career, like most accountants, in audit with a mid-sized firm. And I progressed to corporate advisory, where I was involved in valuations, financial due diligence, some M&A activities, and quite a lot of IPOs. But in the last 10 years, my experience has taken me in various more operational capacities. But I got a glimpse of healthcare, plantation, a lot of manufacturing industries, including even education. I currently have a role in an FMCG company, and I am an independent board member in 2 public listed companies. Hi, Irene. And give us a little brief about you.
Hi, everyone. So yeah, thanks, Su-Ching. So I have a legal background. I worked in law firms, multinational corporates, NGOs, and then I moved towards venture capitalists and startups. That's my introduction. So happy to be part of the Leet team.
Great, thanks guys. Ladies, thanks ladies for introducing yourselves. So I guess we'll sort of dive into today's session or today's topic, right? And the first one's for you, right? Since you're from a legal background, you mentioned, what are sort of the common agreements one would see in an ECF deal?
Sure. So usually there would be 4 main agreements. There would be a term sheet, a subscription agreement, a shareholders agreement, and in this case for ECF, it will be a nominee agreement. So I'll first start off with a term sheet. A term sheet is usually a non-binding term sheet. And in the case of an ECF deal, this would be between the company raising funds with the ECF investors. And usually these term sheets outlines the material terms and conditions that will be stated in the subscription and shareholders agreements later. And of course, it depends on what has been agreed upon between both parties. So the key offer terms usually include the amount raised, the price per share, pre-money valuation, that is value of the company, not including external funding, liquidation preference, just to name a few. But for today's session, we will focus more on the investment subscription and the type of share instruments for an investment, as stated and shown on our term sheet template.
All right, cool. So for those of you who see the screen right now, this is basically a snapshot of the term sheet as well. Probably the most important part of a term sheet is how much the price per share is, because that generally influences how much you would invest in a campaign as well, and as well as the instrument as mentioned. So I think I mentioned earlier. So this is for Su-Ching. So I think I mentioned earlier, right, about ECF. One of the unique parts of an or unique element of an ECF campaign, at least for Leet Capital, is that we use a nominee structure. So I guess educate our investors as well. What is a nominee structure and why is it used? What are the benefits of it?
Okay, this is more, it's got a bit of legal implication and a bit of practical implication. In Malaysia, there is a limit to the number of shareholders for a single berhad. Any entity having more than 50 shareholders will need to be a berhad. So a berhad is a public limited company. And all public listed companies that are listed on Bursa, those are berhad companies, but not all berhad companies need to be listed. So I hope you all understand that. But why is that a problem? In Malaysia, again, all berhads need to be under the purview of the Securities Commission. So the authorities see that if there are so many shareholders, then it needs to be a bit regulated. And there are just more administrative things to adhere to, just for example, quarterly reporting and such. Administratively, you can also imagine the logistics effort when it comes to circulating a board a members resolution as opposed to a board resolution. So members resolution really needs all the shareholders to sign. Because of these, you can also appreciate that a structure where a nominee company which houses a group of shareholders would be more efficient. So the company only deals with the nominee company in the event of a members resolution. Yeah, the investors still, but investors are usually worried now the nominee is representing me, but essentially the investor is still the beneficial shareholder of the shares in the company. The nominee company just holds the shares on the investor's behalf, and the rights of the investor is still protected, and this is clearly stated in the nominee agreement. But on the other hand, anchor investors, if you, in any campaign, if they wish to take a bigger chunk of the funds to be raised, then they can request to be excluded from the nominee arrangement and be named in the capital table. And in this case, if the investment sum is significant enough, then the issuer of the company will normally agree.
Yeah, thanks, Su-Ching. So I think just want to stress again, right? So when you go under the nominee structure, even though the company is so for the benefit of everyone, the nominee that we use is 1337 nominees and Duran Berhad. So that would be listed on the issuer's cap table or the registrar of members. But that being said, right, you don't own the legal you don't own the legal rights to the share, but you're still the beneficial owner. So whatever is accrued, whatever dividends, etc., you will still get all those. The voting right is just represented by the nominee, and we obviously act in the benefit of the interest. So that's something for you guys to know of. So and back to you, right? So today's topic, right, we basically want to talk about the different types of equity instruments. So I think a lot of investors still are not aware of the many different types of instruments, and then even then there's more subclasses to it as well. So maybe on a high level, right, maybe you can tell us about what are the different types of equity instruments usually used in an ECF deal?
Sure. So usually it would be an ordinary and preference shareholder shares. So ordinary and so ordinary is one class by itself, and then preference share is one class by itself. But under preference, there are subclasses, which I'll go into later. So this would be irredeemable preference shares and redeemable convertible shares. Okay,
cool. And when you mentioned earlier there are a few subclasses for preference shares as well, right? So I know there are many subclasses of preference shares, right? But obviously we don't have the time to go through each and every one today. So what are some of the common ones that you've seen?
Okay, maybe let's just talk about ordinary and preference shares first and the differences. Yeah. So for ordinary, I would say for voting rights, shareholders have the right to vote on matters put before all shareholders of a company. But the weight of a shareholder's vote for ordinary shares would depend on the ownership that they have in the company. So typically there'll be one share per one vote. And then for dividends, they have the right to a share of the company's profits by way of dividends, but this really depends and fluctuates. This will fluctuate depending on the company's performance and their profits. The third would be liquidation. So liquidation, if the company ever becomes insolvent, preference shareholders will have priority over ordinary shareholders in recovering their funds back. So in terms of ranking, preference shares would have a higher ranking than ordinary shares in getting back the investment. The next would be preference shares. So in terms of voting, preference shares usually don't carry a right to vote compared to ordinary shareholders. But for the advantage for preferred shareholders, is that they have priority rights in their dividends. So their dividend percentage is usually set out in the company agreements and it's fixed.
Okay. And so I guess my earlier question, right? For preference shares, you've got many different, I guess, subclasses of it as well. So what are the common ones that you've seen?
Right. So like I mentioned before, there are two. We're not going to go into all the different types of subclasses. So I'll just zoom into two. So that would be a redeemable convertible preference shares, or RCPS, and the other one would be irredeemable convertible preference shares. So redeemable, I'll start off with that first. Redeemable just means that the company has rights to redeem back their shares, and there is a maturity date on which the company will repay the capital amount to the preference shareholder, and then the company can discontinue the dividend payment thereafter. Convertible shares just mean that they have an option where shares can be converted into ordinary shares later on. But again, this depends on what the parties have agreed upon in the terms and conditions. The second would be the Irredeemable Convertible Preference Shares, or ICPS. So irredeemable just means that there's no maturity date, and the dividend of these shares are fixed. So these shares can only be redeemed at the time of liquidation of the company. So the company cannot do anything to these preference shareholders, and yeah, it's the dividends fixed throughout until insolvency.
Okay. And so when you talk about an investor's rights, or what's probably, so let's say I'm an investor, I'm looking at an ECF deal right now, and there's an ICPS there that's being offered. So compared to an ICPS or RCPS, how do I know how my rights are different between those two instruments?
As an investor.
Yeah. So I guess my question is, how does my rights differ between an ICPS and RCPS?
Okay, Su-Ching, would you, as an investor, would you like to give your perspective?
Yeah, maybe I'll just jump right in here. Personally, I feel that no one instrument has more rights over the other. It really depends on the terms of the instrument, which will always be spelled out in the shareholders agreement. So that's important. Yeah. However, generally, if the instrument is an ICPS, so the investor has no rights to redemption, only conversion. And the timing of the conversion is dependent on usually an expiry of a certain time or upon an event, usually an IPO or a trade sale. And as for redemption, again, the rights, the shareholders agreement will spell out the conditions. In normal cases, the company has the right to choose when to redeem. But preference shares can be, like in the case of an ECF, available to retail investors, but companies can also issue preference shares to individual investors, which put in a lot of money. So usually in this case, like private fundraising, using preference shares, where the investor comes in with bigger investments, then the investor has the right to negotiate terms. So again, in an investment, I always look at a couple more things rather than the instrument. Yeah. Okay.
So Su-Ching, so now I guess you talked about those of you, I mean, I think Su-Ching mentioned it earlier as well, but she's got a lot of accounting and tax knowledge or experience, right? So I guess for the benefit of our viewers today as well, and I hope our viewers don't fall asleep, but what are sort of the accounting and tax implications when it comes to ordinary versus preference shares?
Okay, before I dive into that, wake up! Really, the accounting and tax really only differs to the issuer, not the investor. So if you're coming here as an investor, now is the time to make your coffee and sit down and enjoy the show. But if you're interested in the accounting part to the issuer, there are a few things to really look at. In Malaysia, we don't have capital gains tax other than real property, and the returns to the from ordinary shares or preference shares is considered a capital gain. So this includes any gains to the investor, which will be accrued to them if they were to dispose the shares at a price that is more than what they bought for. So those of you who have been dealing with shares in Bursa Malaysia, when you make a gain, I know you know that you don't have to pay any tax on that. So that's the current existing laws that we have. But on the flip side, if the investor experiences a loss, that's just too bad. So in that respect, it is fair. And a lot of times tax laws always talk about fairness. Okay, but now the interesting part, at least to me, is the accounting treatment to an issuer. And RCPS, with the R there, it is redeemable. So we have to really look at the accounting standards on the classification of that instrument. So although it's preference shares, as the name suggests, it's a share, the accounting standards might say that because of certain nature of the instrument, it is more a liability than an equity. So in an RCPS, it is most likely, but not necessarily always, a liability in the balance sheet. and as such, the payments of the returns to the shareholder is treated as an expense in the P&L. I repeat again and again, an expense in the P&L, but such payments or accrual will be treated as a capital instrument in a tax computation. So that expense will be added back to the profits to derive at chargeable income. Are you all lost yet? If you're accountants, you probably understand what I'm saying. Go, whoa, revelation, you didn't know. So you can see an RCPS is really not desirable as an instrument for fundraising by an entity from a tax and accounting point of view. But an ICPS is most likely treated as an equity because it is irredeemable, and the only way for the preference share to change form is to be converted. So it will normally, not necessarily always, yeah. So the accounting standards, you have to look at the terms and see how it is going to be defined. And this is usually something that the company does with the auditors at the point of the issuance of the instrument. Okay, so an ICPS is most likely treated as an equity in the balance sheet. And so payments accrued to that equity instrument is considered an appropriation of profits. So it affects the statement of changes in equity, not the P&L. Good, ah. So why is the classification of an ICPS and an RCPS as liability or equity important? Accountants in the house, you may appreciate this a lot more. It's really because the accounting treatment then as a liability and equity has an effect on the profits of the company. And in Malaysia, investors generally understand valuation as a multiple of profits. Okay, so for the issuer, it is always better if it is an equity instrument. Then it will be treated as such and has no effect on the profit and loss. Also, as an interest-bearing liability, the company's gearing ratio will also be affected if the instrument is classified as a liability as opposed to an equity. Now, I will have a test later and see how many will get all the points right.
I hope our viewers, I hope half our viewers are still here.
Nobody left.
That was very informative. So I guess now if let's say we talked about the different preference shares as well. So if I was to, let's say I invest in a company now on ECF that's issuing RCPS to me, right? 1 year later, they go and raise another ECF, a bigger ECF round, and now they're issuing ICPS instead, right?
Yes.
So I basically own ICPS and RCPS. As my rights as an investor, which takes precedence, or which gives me more rights?
Well, the RCPS clearly has the rights of redemption, which is always very comforting for investors because they can see that there is a chance for a redemption at a certain point in time. But when you invest in a company, don't you want to be a shareholder? So to me, this is personal, yeah. The form, the RCPS or the ICPS really doesn't matter. When I invest in a company, I want to know that it is a good company, or else why should I even bother? And so the R or the I is of no concern to me, but that's personal. However, to other investors, please do look at the shareholders agreement. Usually the terms are always stated there. And if you're okay with the terms, then do what you need to do. But if you're not okay with the terms, then don't invest.
Would an RCPS then seem more like a loan?
Yes, it does, to the issuer.
Okay. And I guess,
sorry, again, not necessarily so. We always have to look at who has the rights to call for the redemption. If the company usually has the rights to call for the redemption, and then it might be more equity because the rights are with the company. Does that make sense? Yeah.
Yeah. Okay. And so I guess, are there anything an investor should be concerned about, or any red flags an investor should look for when it comes to these different equity instruments? When they look at a term sheet, if I'm an investor, I'm new to investing, right? Obviously, one is I can go and get guidance or counsel from the Ecf operator, but because we've had the session today, what are some of the things an investor could look out for?
You mentioned red flags, but usually if the campaign is already up on any platform, you can rest assured that certain due diligence is already done by the operator. So there are certain things that are already in place, or else the campaign won't be up. But I just want to highlight that there are just a couple of things that you must be okay with, and please be aware. First, you will be holding shares which are not liquid. So you cannot put in your money today and expect someone to buy it off of you tomorrow. So unless a secondary market is in place, there is no market for the shares that you're holding, not at all. You will need to be okay with that. I cannot stress that enough. You may end up holding the shares for quite a couple of years, probably 5 to 10 years. And if you see all the ECFs that have happened since 2015 was when it first started, but to now, how many of the ECF companies have done an IPO? Probably some trade sales, yes, but not an IPO. But there are companies that are already in the progress of getting that as part of their journey. So if there were to be any transfer of shares, then you will need to find your own buyer and inform the nominee company of the transfer and provide the documentation. Then the nominee company will update the registry. Yeah. So the second thing to look out for, as this is an ECF, the terms will likely be determined by the issuer of the company. It's not for you to pick up the phone and go, hey, Justin, can I negotiate these terms? That will not happen. So be familiar with the terms. If you're not familiar with them already, then because this is your first time doing it, then you have to ask the people who will know and understand them to explain them to you. So in life, I just need to say this because I am of that age. If you need a good answer, you will need two things, right? So the first is the right question and then the right person. If you ask the right question to the wrong person or the wrong question to the right person, you will not get a good answer. And the third thing that you have to know, just apart from the two that's already mentioned, if there is a redemption or a conversion, you have to know when the trigger events are, and if the redemption is at par or at premium. Same with the conversion. What is the conversion ratio? It is not always one preference share to one ordinary share, although that's quite common sometimes. There is a conversion ratio. And maybe what your dilution rights are. So if there's another fundraising, will you be diluted? So those are the things that you should know so that your rights are protected. Also, very important, I feel, what are the long-term plans of the company? I don't think anyone looks forward to be a shareholder for life. So what are the exit plans of the company? And if the company has any aspiration of that kind, either to be listed or to be part of a bigger conglomerate. Yeah.
Okay. And since I'm sure you, as you mentioned, right, you've had many years of experience right, till today.
Another way of saying I'm older than
so I guess it is an angel investor insight series. And I always like asking different investors what are the things they look for, because everyone has their own things that they look into a specific company before they invest in, right? So what are the things, or what are the criteria you have?
Okay. So this is my point of view. Yeah. I only look at three things. If people were to ask me, I would tell them the same. And it's the same whether it's a private or a public company. Firstly, is the industry. Is it a sunset industry or is it something that's up and coming? And about the industry, if I resonate with it. So there are certain values that I hold dear. And if the company promotes those values that I believe in. So that's one. Secondly, is the timing of the investment. If I believe the potential has matured, then there is no upside for the investment. What's the point? I just wish them well and thank you very much. I'll hop on to another deal. But if I see potential and there is enormous upside, then I will invest. And third, and perhaps the most important, are the people behind the company. No company exists on its own. It is the people that creates the culture, everything about the company, the future direction of the company and the products and services that are created. Integrity is very important. I have seen enough cases to understand that one person can make or break a company. Energy is important. If I see the CEO talk and he goes like this, then I won't invest, no matter how good the industry is or even if the timing is right. And the spirit of the company is important. Do you get a good vibe when you see the annual report or you read about them in the papers? And if you have an opportunity to then know whether the company is situated, then go past it and see whether you like it. And I will normally do hold on, I'm not done yet. I would normally do a bit of homework before I depart with my hard-earned money, and so should you. Yeah. A lot of people just listen to others and say, oh, this is a good stock to buy, and they go ahead and buy it. That is not the way. That was the way when I was younger and a lot lazier. Now I understand the value of money a lot more. So that is something that everyone should do. Again, if it is a publicly traded company, information is available from SSM and all that. If you're not sure, again, ask your friends who are accountants. And for that reason, I only have invested in one private company.
Okay.
Yeah.
I guess we don't need to disclose the company. Yeah. So I think following up on that, right? So I think when we have our ECF campaigns as well, as an investor, you shouldn't just follow. Have a herd mentality, lah. Don't just do it out of FOMO, fear of missing out. I've been subject to that as well. I've done it as well, but it's not the best way to invest your hard-earned money. Always ask questions. We don't see enough questions in an ECF campaign. There'll just be maybe 6 to 10, but that's not enough for 100 investors that are investing in a campaign. There needs to be more. You need to ask a lot of questions. Make sure you're comfortable before you invest in a campaign now. Okay, so I think we had a few questions from the crowd as well. So I'll just read them out to you and you guys can sort of answer them. So Mr. Taquin says, to sum it up, because of the redeemable function of RCPS, it would be treated as a liability rather than an asset to the investor.
To the investor?
Yeah, to the investor.
No, to the investor, it's just an investment.
What if the investor is an entity? Does it matter?
If the investor is an entity and the investor has purchased this instrument, it becomes an asset. It's not a liability.
Yeah. Okay. So it would be treated as a liability for the issuer, not the investor, right?
Correct.
Okay.
Yes.
And he followed up and asked, does RCPS have a maturity date? If there is a maturity, would it be considered an asset rather than a liability?
The maturity date is one of the factors that companies and together with the auditors consider in classifying whether it is a liability or an equity, but it's not the only thing. There are other things that they look at, redeemability, convertibility, even the timing. So this is just one of the factors. So I can't say because it has a maturity date, therefore it is. There's no such thing.
Yeah.
The standard is like this thick, so thousands of pages long. So
and
if you
also,
have,
and also because an RCPS is redeemable, right? So by default, and RCA in a normal default scenario, the redemption is for the company, right? So
yes,
by right, it's technically a liability or a loan in other words. So it would be considered a liability. So the maturity, I guess, you could think of it as the tenure of the preference shares, and usually it's 3 to 5 years, and so it would be considered as a liability. Okay, and Miss Susan had a question for you, Su-Ching. My company is a private company that requires 51% Boomi shareholders due to licensing. How do I able to raise funds?
Talk to us later.
Okay. So Miss Susan, you can personally reach out to us and we'll be happy to help.
Yeah.
And we got another question from Mr. Karul. What about when investors wanted to invest into a startup in a different country? Which instrument and exit strategy is recommended?
In a foreign country,
Yeah.
so you're talking about an ECF that is done in another country.
Well,
sorry?
I would say, I mean, you're still investing in a startup, right? No matter which country it is. And so your sort of what we spoke about today in terms of your rights, everything really depends on what's in the term sheet or the subscription agreement. Every company can sort of be flexible in what they offer. If it's an ECF campaign, you need to sort of, as an investor, go and read the term sheets, read the subscription agreement, see see what rights you have as an investor, what instrument and all. It doesn't. It's the same which country you go to, but in terms of what rights you have, that is all subject on a case by case basis in a specific deal. And I think exit strategy, I think Su-Ching mentioned as well. So Su-Ching, the exit strategies would be the same as well, right?
Yes, it would be. But it's just an added thing. If it is another country, then even the companies that I work with, whenever we go to another country, the first thing we want to know is what are the operational regulations in the country. So if you're going in as a personal investor, then will you be taxed? Taxes is always a big thing. So now laws have changed from January onwards. If you earn money abroad and you bring back, now you'll be taxed here as well. So you have to be familiar with the local taxes in the country in which you want to invest in. And also, please check with your tax agents or your tax accountants on whether there are double tax arrangements and whether you will get a tax shield if you've already been taxed once when you bring it back to Malaysia. Yeah.
Okay. And we had a couple of questions before the session started as well, that we got in advance. So the first one was for you, Su-Ching. Is being an angel investor a job, or is angel investing a full-time job?
That is like asking if shopping for deals is a job. And yes, it is. And here we believe that angel investing is a full-time job. In the Leet group, we not only nurture companies, especially startups, but we invest in them as well. So when we invest in startup companies, we are by default an angel. As an extension, the Leet Capital is a platform where we invite other angel investors to have access to the potential deals that we are helping to nurture and assist. And here in Leet Capital, we arrange for special previews to angel investors to have a glimpse of the akan datang deals. So in a nutshell, yes, as I have described just now, it is definitely a job for us.
Okay. And a question we had was, how much power does an investor have to sort of negotiate, right, the terms, whether it's an ordinary preference, and then sort of their rights as well in a deal. So how much as an investor, how much power do I have in an ECF deal?
Mm-hmm. Sure, it's up to the company raising, but we will advise which is best from an investor's perspective. Because it's an ECF, it usually depends on the company to decide, but the negotiation will happen between the Ecf operator and the company raising usually. But however, versus a typical private equity deal with a VC, the VC would create the term sheet first and then provide it to the company later. Okay.
And I think we had a question on safe notes as well, which is interesting. So for those of you who don't know, safe notes are SAFE. They basically stand for Simple Agreement for Future Equity. And so what it started with Y Combinator, and the reason why they started it was to sort of give founders a means to quickly raise money, especially these early stage startups. And a lot of times these early stage startups, because they don't have anything, right? So they can't come up with a valuation. So you can't do a price round as how you would do, going to a VC, it's normally a price round. So that's how the safe note sort of came about as well. And so we've been dabbling in a few safe notes as well through our VC 1337 ventures. But we also now are trying to explore the possibility of doing a crowd safe as well, getting a few angel investors or sophisticated investors to group them in and try doing a crowd safe, and not an ECF safe, a crowd safe, because there's no equity offered, right? So it's a crowd safe. But this would obviously just be limited to our high net worth individuals due to the risk. So if you're an angel investor, you're a sophisticated investor, and you want to be a part of something like that do reach out to us. We have an exclusive club, and where we reach out to you in terms of deals like that. So I guess that's pretty much all the questions that we had. I don't think there was anything else in the chat as well. We also have started doing a term sheet template. Can you guys see my screen?
Yes. Hold on. It's still that.
Still buffering, yes, Steve.
It's still buffering. I'm not sure why we're having issues sharing the screen. Just give me a second.
Let me share that, Justice.
I think Jester has dropped off.
Okay, let me try again. Okay.
Oh, there you go.
Yeah, so we basically sort of our team basically sort of drafted a term sheet template. Mind you, this is just a template, so we went with a basic ordinary shares template. So if you like access to that as an investor, if you want to see how a term sheet looks like, a standard term sheet, or if you're an issuer that wants to see how a term sheet looks like as well, you could sort of scan the QR code, or the link will be put in the chat as well. And you can sort of have a look at some of the clauses, the structure of some of the terms that are used in an agreement. I know we took a snapshot earlier to show you the subscription price and the type of equity instruments, but there are also other clauses that are very important, like the anti-dilution rights, etc., etc. And if you're new to this, especially as an investor, if you're new to this and you don't understand what some of these clauses mean, you can always reach out to us. We're happy to help you. We like stressing on the education element of investing as well. So do reach out to us if you have any issues with that. And I think that's it for today's session. Thank you so much, everyone who's joined us for today on a public holiday. And yeah, have a great long weekend, I guess. And we'll see you guys until the next. Mr. Techman is asking. I mean, if you want to do a quiz, you can. You can ask them and they can put the answers in the chat.
Oh, there is a question. What happens if
what happens if a company is unable to raise the target amount? Yeah, so I think what we've seen in ECF campaigns, and that's why it's really important for the Ecf operator as well to do your own due diligence and negotiating with the company itself, right? And that's why we like to say it's very important, the role of an ECF operator, because you're doing that DD process, you're negotiating the terms, you're even doing roadshows for the issuers to go and meet the investors, right? You're setting up that whole campaign, basically like what an investment bank does. Obviously not at that large scale, but the same thing on a smaller scale. And so when it comes to the target raise, we've seen companies, we've seen companies want to do like maybe 5 to 10 million or something like that. And we go and tell them that you shouldn't do that, because then a lot of questions, what will happen is a lot of investors see that as a red flag, right? Because it's a huge difference. What do you need like from 3 million all the way to 10 million? What happens if you only reach 3 million? And so a lot of investors see that as a red flag, and we are skeptical of that as well, which is that's why the role of the ECF operator is very important. And so coming back to your question about what if a company is unable to meet the target raised target amount, so there's usually a minimum and a maximum target. And so if a company can't meet its minimum target, then whatever funds that is raised up to the date, up to the end of the campaign period, is normally refunded back to the investors. So investors get back all their money. As long as you meet the minimum target, you can the issuer gets to keep whatever money as well. That's why it's always good to be a bit more conservative in your minimum amount. And coming back to the refunds or the returns, right? I think a lot of investors are not aware as well that even after the campaign ends, if you had a change of mind, if you decide I don't want to invest in the campaign anymore, I need the cash actually for any emergency purposes, there's usually a 6-day cooldown period after the campaign ends. And so if you had a change of mind, you can always request for a refund. And all these are all stated in the agreements on our website in the campaign. So once again, have to stress on it. Even though it's very comprehensive, this agreement, it can be a bit boring, but do take the time. You are putting your hard-earned cash into the business. And Is there anything else? I think that was it.
I think maybe just a wrap up from my side. This is the reason why we have all these series to educate the public. We realize that although there might be campaigns out and the campaign may be a good investment choice for some investors, but we realize a lot of investors, they do not know what they're getting themselves into. So that's why the education begins now. And if you never start, then you will never be able to appreciate the things that go on in an ECF. So do take advantage of the talks that we have. Come and participate and ask a lot of questions. Be interested, because if you're going to put in your hard-earned money into any campaign at all, then at least you go in with two eyes wide open and not just blindly going in. Okay, so that's all from me today.
All right, thanks so much. And once again, before everyone leaves, we'd like to get sort of a feedback. We do want to always improve on what you've seen today, or what are some of the topics that you want us to do next. Obviously, if there's a specific topic that you like to see that we've not covered before, we'd love to get your feedback on that. And so yeah. So thanks once again, everyone, for coming to today's session. Thanks to our speakers as well, Su-Ching, and thanks for your time on a public holiday. And yeah, for everyone who tuned in today, have a great long weekend. And we'll see you in the next session in a month's time, I believe. All right, take care. Bye-bye.
Thanks, Justin. Bye.
Thanks, Steve.